Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm joined today by Kirby Rappell, the General Manager, Research at SuperRatings. Welcome, Kirby.
Hi, Tony. How are you?
I'm good, thank you. Now, yesterday you put out some results for superannuation returns for the end of 2016. So I just wanted to go through those results with you today.
That sounds fantastic.
Good. So what did the results show us, Kirby?
Look, it's been a pretty good 2016 for most super funds. So the average person in a balanced option got about a 7.3% for the year, 7.3% return for the year, which is actually a really good outcome.
And just for the benefit of the listeners, what exactly is a balanced fund?
A balanced fund is usually the default sort of offering for most super funds in Australia. It's about where 70% of people are invested, and that sort of fund looks like it's something with about 70% growth assets, so a good exposure to Aussie shares, about 25% there, about 25% in international shares, probably about another 10% in property, a little bit of infrastructure, private equity, hedge funds, and then some defensive allocations to fixed interest in cash as well.
Okay, so you mentioned the return was 7.3% for a balanced fund. What were the key drivers behind that?
Look, it was driven very much by the back half of the year. There's a lot of volatility going on, no doubt, with after Brexit and the US election going on. And we actually saw some rallying equity markets. So Australian shares were the best performing asset class for the year. They're up about 10.3%. International shares also had a pretty good time. They're up about 7 to 8%. And then property actually did pretty well as well. They delivered about 9.6% return for the year.
And I noticed also that there were fairly good returns out of global infrastructure and emerging markets.
Yeah, it's been really pleasing to see that within that balanced fund you get some really good diverse exposure around the globe across a lot of asset classes, and emerging markets and infrastructure had a pretty good time, which was pleasing to see. And something you're seeing a lot more funds focusing on is how do they get co-investments overseas in high quality infrastructure projects.
And of course, the lowest performing areas were really fixed income and cash, which is probably not a surprise, but we know that a lot of investors do have a high proportion of funds still in cash.
Yeah, look, it's a really tough time for cash. I think the only thing that made cash look good this year was the fact that inflation's also been so low, but the median fund had a 2.1% return on cash, and for people looking to derive a good income from their super, that's a pretty challenging return to work with.
So for a self-directed investor, what are some of the key lessons they can take out of these managed super fund returns?
Look, there's a couple of key takeouts, I think, for the self-directed investor. The first one is the importance of diversification, both in the portfolio itself, if you're looking at your Aussie shares portfolio, but secondly, across your asset classes. So some self-directed investors have been a bit light on in some of those alternative asset classes, maybe some access to some direct property or to some infrastructure exposures or even emerging markets that you alluded to earlier. And so it's making sure you've got a good diverse asset allocation. We're in a low return environment, and so you need to make sure that you're eking out any gains you can in a good risk controlled manner.
There's been a lot of commentary about what to expect out of 2017, especially around volatility. What are the expectations for super fund members?
Look, it's going to be a challenging year ahead. If you have a look at what super funds are expecting, you're noticing that they all disclose an objective, which is an inflation plus sort of measure, and typically that's been 3.5% historically. And what we're finding at the moment is a lot of funds think we are well and truly into a lower return environment, notwithstanding some positive surprises, which would be nice if they do eventuate, but most funds are probably planning for a little bit more subdued environment. So they've dialed back their objectives to a CPI plus 3% measure, and that's going to be with us for a little while. We've seen huge run-ups in out of the back of the GFC and a lot of listed equities markets, as well as infrastructure and property, and funds are sort of probably a little bit less optimistic that it's going to be quite as easy to get those returns going forwards.
So it remains to be seen whether we can meet the same level of return over the course of 2017. Of course, in 2016 the market started down quite sharply, and then it tended to recover over the course of the year. So it'd be interesting to see.
Look, most definitely. If you have a look at the calendar year return for 2016, we're only about 2.5% up at June, but the last 6 months of the year really helped to drive that 7.3% return. So for the financial year return this year, it means the first 6 months of that return looking pretty good. But obviously, remains to see whether we can keep that the steam behind some of the markets we're seeing.
Well, we'll leave it there, Kirby. Thanks very much for coming in, and we look forward to talking to you again next time.
Thank you very much, Tony.
Thank you.